Street Week with Louis Rukeyser is made possible by the financial support of viewers like you. By The Travelers, providing American business with insurance, investment services, and managed health care. The Travelers. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential-Bache Securities. Rock solid. Market wise. Produced Friday, February 15. Our panelists are Alan Bond, Elizabeth Dater, and Carter Randall. Tonight's special guest is Kurt Feurman, Principal, Morgan Stanley and Company.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, it looks as if we're going to have to call the Missing Persons Bureau and put out a tracer. Someone somewhere must have seen him somehow, but suddenly in his usual haunts, and I do mean haunts, he's nowhere to be found. I refer, of course, to that much publicized and supposedly fearsome malefactor, the Great Bear Market of 1991. Where can he have gone? Just a few weeks and a few hundred points ago, the woods were full of super bears. Every discredited gloomster of the 1980s was out a-growling, maintaining that he may have misled you in 1982, he may have missed by a mile in 1987, but like some strange beast slouching toward Bethlehem to be born, he was sure his frightful day had come round at last. You betcha. What a difference a month makes. In the past 5 weeks, despite war in the Middle East and recession at home, investors have begun to look down the road a bit further and to like what they perceive beyond the horizon. The Dow Jones Industrials have gained a whopping 443 points in those 5 weeks, soaring back above 2,900, and two broader averages, the Standard & Poor's 500, which is the one by which the leading pension funds and other institutions measure their performance, and the New York Stock Exchange Composite, which keeps track of every common stock traded there, both stand tonight at all-time record highs. Some big, bad, multi-year bear market, folks. And one more victory for those sensible long-term investors who didn't let the so-called gurus distract them from keeping the faith and persevering with a program of buying and holding quality common stocks. For the rest who were foolish enough to be panicked along the way, my sympathy, and the humble suggestion that next time the world seems to be coming to an end, they remember that excellent British phrase and not try to be too clever by half. So what does it all mean? Is it all straight up from here, now that the latest bear market has been buried? Clearly not. Markets never go straight in either direction, and this one may well have some nerve-wracking moments ahead. There is, for starters, the Middle East, as the world holds its planetary breath and waits to see whether the final bloody ground assault is about to begin. Wall Street seems to have made up its mind that any such battle will be shorter and more successful than generally feared. But as we've often noted, Wall Street can be awfully wrong. There is, moreover, still the pesky question of the American economy, which is not only in a recession, but apparently in a deepening one. This week's confirmations of that sorry fact included still declining retail sales, with the big three automakers registering their worst fourth quarter ever, a further decline in industrial production and factory operating rates, and more bad earnings news from the banks. Why the optimism, then? Well, because the softening is now so obvious that the Federal Reserve is pumping money like mad to deal with it, comforted by the knowledge that producer prices are still falling, and with them any immediate concern about inflation, and by better news in such pockets as trade. Nirvana is clearly not yet at hand in the American economy, but neither, it would appear, is Armageddon. We tonight will get back to basics with a look at what's going on in America's food industry. But first, let's see how the bull ate the bear this past week in Wall Street. And as the Dow Jones Industrial Average indicates, it was another tough week for those disappointed bears waiting for the market to sell off so they can bail out. Soaring above 2,900 for the first time since last July, before the Iraqi invasion of Kuwait, the blue chip average gained another 103 points to 2934.65, only about 65 points from its all-time record. The S&P and New York indexes did go to new highs, while the secondary indexes are back to their midsummer levels. And there's a new convert among our elves. Chief Elf Alan Shaw switched his vote from neutral to bullish on the technical outlook for the next 6 months, restoring our elves index to a strongly bullish +4. The great bond rally stalled this week, while precious metals continued to disappoint their die-hard supporters. So complete has been the turnabout in Wall Street's mood that stocks rose both on rumors of peace and after denials of those rumors, while oil prices retreated and the much battered dollar regained some respectability. And if your broker seems to be in a better mood, perhaps it's because the New York Stock Exchange had its first back-to-back billion-share trading weeks in nearly 3 years. So maybe you won't have to hold that benefit for him after all. Carter Randall, so far your New Year's predictions are looking great. You pegged the low on the Dow at 2460. The actual low so far was only 10 points away. Your high prediction was 3060. Would you want to peg that one higher now?
No, I'll stay with that for a while. I think we're going to have obviously a correction in this strong market, and the economic news is not going to be good for another 3 or 6 months. So we may see some bumps, and of course there's still the possibility of some bad news coming out of the Middle East, which would affect the market emotionally. It has nothing to do with true value in the market, but emotionally people do sell when they're worried.
Presumably, from the stock market's point of view, the best news has been interest rates. How much lower do you think they're going to go?
I think we've got another 100 basis points or 1 percentage point to go down on the basic interest rates. And of
long
course,
and short?
Long and short rates. And I think, of course, that means we could capitalize stock earnings at an even higher rate. So I'm still optimistic, and I'm telling people to hold those good quality stocks, but the market could get overbought here. It's almost a panic buying kind of situation.
Well, 5 straight up weeks of this size, it would be crazy not to have a correction at some point, wouldn't it?
Well, that's right. We should have a correction, but we may push the market much higher just because so many investors, institutional and others, are coming in at the last minute not to be lost, and that might push it too high.
Best data, the market strength surprised you, but it surprised a lot of people. What do you think of what it's done?
Well, I think that the market has overwhelmed the wall of worry that it's been climbing here, very definitely. And, I really think, Lou, that what's interesting about this market is that it's moving on expectations of growth, and it's moving on expectations of lower interest rate and lower oil prices, fundamental things, as opposed to the kind of buoyant markets that we saw in the 80s that were moving on takeovers, arbitrages, sort of non-productive kind of expectations.
So that's, in the long run, much more favorable.
I believe that it is, yes.
Now, you talked about growth. We haven't really seen much of that lately. When are we going to start seeing that?
Well, the problem is I do think the market may be a bit ahead of itself here. The market is telling you that we've won the war, it's over, and that there's going to be a shallow recession. I mean, we still have an economic situation out there that's unlike any we've had in my lifetime, in that it's debt-related and it's credit crunch related. So I think that if there's any exacerbation of the political scene or problems with the war, that we might well see a far more volatile correction than some people are looking for. I'd look for a trading range which would be pretty wide, actually, over the next year. I sort of come out in the middle ground, but I mean, I can really make a case for 2,300 to 3,300 kind of range in this sort of environment.
Do you know which one will come first?
Sort of looks like 3,300 at this point.
Tonight, we have the pleasure of welcoming Alan Bond to our revolving group of panelists. Alan was a super guest for us a few months ago. Nice to have you back as a panelist. You know, you're in the perfect position that you've never said a wrong thing as a panelist. You've never given bad advice. Would you like to continue that record by telling us what you think of things now?
Well, I think the market has done extremely well, and I think that it's poised to continue to do that. I really think the news that we got this morning gives us an indication that the war may be moving in the right direction, and that with the compelling cash levels that exist right now, and that we're going to see that cash put back into the stock market, and that we move higher above 3,000.
By some measurements, there still is an awful lot of skepticism out there. One of those measurements being all that cash you're talking about. At what point do you think that cash gets committed?
Well, I think we've seen most of that cash start to be committed to the market. It's come down from the 13% level a month or so ago. I think a lot of it has been the retail investor moving into the market, and I think a lot of the institutional buyers who may have lagged the market in January are now waiting for the correction to get into the market. And and that gives the market the punch that it may need to move to higher levels.
Doesn't accommodate them very easily, though, does it?
It doesn't.
What do you think of bonds at this level?
Well, I think bonds don't offer the same type of rewards that stocks will offer in 1991, and I think we've seen a very accommodative Fed. We'll probably see the interest rates, I believe, in the long bond move down another 50 points before all is said and done.
But you think more action in the stock market?
I think more action in the stock market in 91.
All right, in any event, panelists, it is time now to send some Valentines to our viewers. Carter Randall, Hugh Emerson of Rockport, Texas, would like you to demystify the subject of federal funds, what they are, how the rate on them is established, what role the Federal Reserve plays in setting that rate, and why the rate is significant.
Well, very briefly, the federal funds are money borrowed by one bank from another bank, and they do it in federal funds. Banks are borrowers, and they are also lenders to each other. And the Federal Reserve is the biggest borrower and lender of them all, and the Federal Reserve sets the rate at which these transactions take place. That rate represents what money costs the banking industry. And therefore, what money costs them has a direct impact on what they charge to their borrowers, and therefore where interest rates in general will be. Following the trend of the federal funds rate can often give you a clue as to the future for interest rates generally.
Definitely worth making a federal case of it.
Absolutely.
All right, Beth Dater, a number of our older viewers living on their retirement income think you Wall Streeters have tunnel vision, the way you applaud lower interest rates. So for the benefit of Neil Ford of Florissant, Maryland, Philip Haberman of Madison, Wisconsin, and some others, would you tell us first why anyone living on interest income should be happy about lower interest rates? And second, whether you have any tips as to how they can protect themselves as interest rates fall.
Sure. Lou, theoretical happiness should come basically because lower interest rates usually mean lower inflation. And when you're on a fixed income basis, your purchasing power is eroded really by any changes in your constant income of that nature. Protection can come really, I'd give three words of advice. I'd say, or three pieces of advice, yes, excuse me. First of all, I would extend maturities. Secondly, I'd stay away from callable bonds or bonds that can be redeemed before maturity. And thirdly, I'd stay with high quality because low interest rates can also mean recession, and you want to be very careful about the quality of the companies. Finally, I would say that Business Week in its February 25th issue has got a listing of all the mutual funds in the total fixed income area with its yields, which I would recommend to our clients, to our viewers to look at.
Available at your local library for free. Alan Bond, Shirley Nicholson of Sioux City, Iowa, notes that Americans of all ages are placing greater emphasis on bodybuilding and physical fitness in general. With this in mind, she writes, I wonder if it might not prove profitable to become a stockholder in one or two of the leading companies that manufacture exercise equipment.
Well, my advice would be that many of these companies are very small and they're owned by larger entities. But this industry certainly has grown as Americans have gotten into the exercise. It's now $1 billion industry. But there are a couple of companies that I think investors could get pumped up about. One would be Precor, which is owned by Premark International. They make probably the best quality treadmills in the industry. But they about $55 million in sales, and it's a $2.5 billion company. The other is CML Group, which makes the Nordic track skier, which apparently is growing gangbusters and looks very attractive. Will probably grow earnings at about 30% clip over the next 5 years.
All righty, no guarantees as usual, but if you would like to muscle in on some profits and build up your sagging assets, we could be your stair climber to the stars. So get off the financial treadmill, start exercising your options, and vice versa, by sending your best developed money questions to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. And let's get fiscal, baby. Now, before we meet tonight's special guest, who covers the food industry, let's check out the trends by taking a look at what you'd be likely to find this weekend if you decided to cruise down the aisles of your favorite supermarket. So come along with me as Uncle Lou goes shopping. Health and convenience moved strongly up the nation's shopping lists in the past decade.